Hi there, everyone. I'm Eric Gauss, Chief Economist of Dodge Construction Network, and I'm happy to welcome you here to our webinar today, Struggling to Regain Traction. We'll be talking about what's going on in the macroeconomy and how that impacts the construction industry. Before I get started, just a reminder about Dodge Construction Network. Our company tracks all the projects, construction projects in the United States from their earliest planning phases all the way through to construction start, and in some cases even beyond that through to completion. Today we're going to look at a forecast of construction starts. That's typically where we focus a lot of our attention here in the economics group. We'll start first with an overview of what we see going forward in 2026 and 2027. The main message here is that there is certainly going to be slower growth ahead, certainly compared to when we last were looking at our forecast in January. A lot of that has to do with what is going on in the Middle East. Higher oil prices naturally are going to impact the construction industry, which is overly sensitive to gas prices, particularly diesel. So you'll see the impact is even more acute in 2027 than in 2026 because those are the projects that are far away enough that might actually get scaled back, whereas the projects that are sort of in train already, there's some gaming the system that needs to be done. Again, a little bit less growth in 2026, but 2027 is certainly going to be close to zero. We're going to start with where this is all coming from. We've seen in the military action in Iran and the closing of the Strait of Hormuz have a pretty immediate impact on GDP growth. We're seeing here a change in our forecast assumptions about GDP growth. Basically, we assume that there would be a lot more growth in the first half of 2026, which would tend to yield fairly decent growth in the construction industry for the whole year. In contrast, now we have to scale back our assumptions about the first half of 2026. It will be a little bit stronger in 2027, but still around 2% growth, which is about potential growth, maybe even a little bit below. It kind of depends on what our productivity assumptions are, and there's quite a bit of uncertainty around productivity assumptions given the pace and extent to which AI is going to be transmitting through the economy. Generally speaking, though, the economy is sort of fraught with uncertainty, and that is sort of reflected in the data. If we turn to the jobs market, we're starting to see really wild jumps in the numbers that are coming out in the employment report. Tomorrow is, of course, Jobs Friday, so we'll get another read on what's going on there. I suspect that, compared to last month, we'll see employment growth slow again, be relatively low. We just had a very large number last year, over 100K. And so we expect that to be a lot smaller. What I'm going to be really interested in is whether we continue to have these series of negative revisions. That makes economists really nervous because of the way that the survey is administered. We tend to get revisions for 2 or 3 months post the period that we ask the survey, or the BLS asks the survey. And when we get negative revisions, that's actually a signal. Generally, the types of firms that take longer to respond are those that are struggling. And so therefore, you tend to have more negative numbers when there are more firms struggling and responding to the survey late. And so that's one of the key things that I'm going to be looking at this next jobs report. I expect it to roughly fall in line with what we've had in the past year or so, which is basically flat, no growth in jobs. So if we did sort of a moving average, we would sort of get to around zero, or at least statistically speaking, nothing different from zero. With a job market that's on shaky ground, we naturally get nervous and worry about, and this is a job market that's been on shaky ground for a while now, we get very nervous about recession odds. And so I always like to pull out my recession probability model. I have two at the moment because I'm still incorporating this policy uncertainty variable. This is, I think, really, really important in the current context, given that there is so much policy uncertainty. It's not a variable that I would normally include in a recession probability model, but I think under the circumstances, it's important to see what the differences are with and without that policy uncertainty. And the important information that I gather from this graph is that there certainly is a gap, and that gap has existed for most of 2025, maybe even into 2024, and certainly is continuing to be problematic. However, even if you take away the policy uncertainty, the fundamentals of the economy are certainly deteriorating. And you can see that in that light blue line, which is almost at 40%. Well, if we're at around 40 to 60%, I probably put my subjective odds of recession probability between 45 and 50%, which is to say, I do not have a recession in my forecast, or at least in my forecast assumptions. However, it does seem like this is something that we should be really, really sensitive to. The Federal Reserve clearly is. They're really concerned about that. The last meeting, there was a lot of contention about whether the hawks or the doves on the committee would be able to win out in terms of future policy stance. However, of course, they are very nervous about inflation as well, not just what's going on in the jobs market and what's going on in the real economy. However, what's also happening is a huge oil price acceleration, which is flowing through pretty rapidly into prices. In this chart, you'll see the WTI oil price through March in that dark blue line. The scale's on the right-hand side, and it's nearing $100, as we're all pretty painfully aware. And of course, that's flowing straight through into those consumer prices, basically through the gasoline pump, right? So if you look at that brownish line, you see a big spike up in March. That's almost entirely due to an increase in gas prices. The core PCE has been increasing along the way as well. Core PCE is, of course, what the Federal Reserve is using to think about when they're thinking about their 2% mandate. That is around 3%. And if you sort of squint a little bit, you'll sort of see that that was rising even before the oil prices started to flow through. It will take a little while for those oil prices to flow through, but eventually we're going to see higher core PCE, probably in the neighborhood of 3.5%. It depends on how long oil and gas prices stay high. And that's, of course, going to be a concern, which is why there were 3 dissents trying to remove any dovish language in the Federal Reserve meeting notes. The whole idea here is that there is a very big tension. There was one dissent that wants to lower rates. That person on the committee must be very concerned about the job market. But those 3 dissenters on the opposite end are very concerned about this chart, the fact that that inflation is high and could continue. For now, our assumptions about the Federal Reserve policy is that policy remains flat through the rest of the year. Presumptive nominee Kevin Warsh is unlikely to be able to sway the committee to lower rates this year. However, we do anticipate that those rates will come down in 2027. Maybe earliest we might see a cut is in December, but again, that's at the very, very end of the year. It's unlikely to have much of an influence in 2026. Another important point on this chart is that the 10-year Treasury rates are elevated and will remain elevated even if the short end of the yield curve, driven by the federal funds rate, starts to come in a little bit. A lot of that has to do with sort of risk that is broadly defined out there in the geopolitical risk that's out there right now. Some of that has to do with Iran, but there are also other policy decisions and communications around the United States government that make it really challenging to think that the world is calm and stable. Another component of this is higher debts and deficits. That's also going to sort of create a floor for how low the 10-year Treasury yield is going to go down. That, of course, then gets reflected in things like the 30-year fixed mortgage, which is the dark blue line on top. That spread, we do see it narrowing to a more fundamental 170 basis points, which is roughly speaking the average, pre-COVID spread between the 10-year Treasury and the 30-year fixed. It will take a little while to get there. In this particular case, that means that the 30-year fixed is going to stay above 6%. That threshold is actually really, really important for the residential market and is probably going to be one of the reasons why residential is going to be struggling in the future. All of that tied together comes full circle to what we should worry about in terms of a downside risk, and that is clearly stagflation. And this is my little dashboard that helps me sort of keep track of all of the different statistics that come out regularly that give me some sort of read on what's happening to inflation and growth. Clearly, if we look at core PCE and CPI, those prices that are sort of fundamental to what's going on, they are clearly flashing inflation. They are fundamentally not close to 2% or consistent with the Fed's 2% target. More troubling is the direction of travel. They're heading in the wrong direction. They're not slowing down. They're actually accelerating. So far, if we look at expectations via TIPS or the 5-year forward, those things tend to tell us that more or less we're okay, but again, TIPS are heading in kind of the wrong direction. If we look at wages also seem to be okay. However, they are sort of stagnant. They're not really going anywhere. So for now, there doesn't appear to be a wage price spiral, which is what the Federal Reserve would really care about. Expectations don't seem to be meaningfully unanchored. However, as we see all the different expectations, if we look at consumer expectations instead of these sort of more market-based expectations, those are deteriorating rapidly. It's not too wild to expect those expectations in the market to deteriorate as well. That's what the Fed is going to be worried about, and why the hawks are trying to send a signal that we need to be really careful about the inflation front. On the growth side, again, employment isn't disastrous, but it's clearly heading in the wrong direction. The unemployment rate, again, is moving very, very slowly up, but again, not to any level that would make us very, very concerned. The same is true of claims and layoffs. Again, there's a lot of noise there, but nothing there is really screaming that there's a problem in terms of growth. This is probably, if you look at this chart, why the hawks are tending to dominate in the Federal Reserve's comments recently. So that's sort of the broad economic picture. I always like to give that so that we get a sense of how the construction industry is trying to play in this particular space. So turning to some of our planning data, we can get a good read on what's sort of coming down the pike. Our Dodge Momentum Index looks at the projects basically as early as we can get them stepping through the planning phases, and adds up all the value of the projects that are under consideration. What you'll notice here is on the left-hand side, we have our commercial DMI. On the right-hand side, we have institutional. This is just to sort of break that out so that you can see the differences between the trends in those two categories. Within commercial, we actually also take out data centers because there has been a lot of growth and a lot of planning going into data centers. So if you look at that brown line, that's actually the commercial DMI without data centers. And if you sort of look at the most recent data point, it is actually more consistent with 2024, 2025. There was a blip in the middle there of a lot of projects that came through in 2025. However, generally speaking, we're kind of back to this steady as she goes on the commercial side. On the institutional side, activity seems to be elevated. It is sort of consistent with if you had drawn a line from 2012 to 2019 and you drew it straight out, you would probably hit that trend pretty nicely. So that seems like, we had a dearth of projects from the pandemic era, and now we got a spike of extra ones, and we're sort of settling back to normal. What this means is that there are a lot of projects in the pipeline. However, while traditionally the DMI has had a high correlation with starts about a year to a year and a half out, we have been noticing a trend that I've been talking about for a while now of these projects moving more slowly through the pipeline. Now, it depends on which sector you happen to be working in, but some are much worse than others. Take, for example, warehouses, where the timeline through the pipeline is more than double what it was pre-pandemic and even through the early pandemic time period. Even in manufacturing, we're seeing things markedly slow down by almost double. And the same is true for multifamily and hotels, where we're seeing a very clear deterioration in the length of time that it takes to get these projects through the pipeline. Which means that even though we have a lot of projects in the pipeline, we don't expect that rollout to really hit until 2027. And even then, it's going to be spread out over a longer period of time. So even though there are a lot of projects, the impact of that will be sort of bled out over many, many months. One of the exceptions that you can see on this chart is retail, where we're seeing a very, very quick turnover. And that's largely because, one, there was a really massive hit through the pandemic, but also because there's been a shift in retail from new additions to more and more renovations. I'm going to spend a little bit of time highlighting a few of these sectors specifically. First, starting with residential, since that sort of tees up where geographically there seems to be some strength and weakness in the construction industry. The nice way to look at this is our work that we do on estimating the housing shortage. We do this by looking at vacancy rates by state. We look historically at what sort of the sort of normalized fundamental vacancy rate tends to be for that state. And then we look at the current vacancy rate and estimate how many homes or how many units would need to be added in order for those vacancy rates to trend back to their historical averages. Turns out that the most expensive markets, largely the New England states and the West Coast, Washington and California, are the ones where we're seeing the largest shortage. Areas in the South, the Sun Belt, built out like crazy in 2023 and 2024, and we're seeing still some oversupply, only a little bit, but enough to sort of recognize that there's going to be a slowdown there in terms of construction. Basically, we have to wait for people to be moving in and sort of driving that market forward a little bit more. What that means is that the markets where you see in sort of reddish pink on that right map, those will be relatively strong in the commercial and institutional sectors relative to the south and the middle of the country. But again, these are just degrees. Overall, there's going to be a little bit of softness. So I'm going to now slide over to the hotel market. One of the things that we are noticing here that is sort of mirroring some of the sort of one-sidedness of the economy and why the economy feels so shaky is this idea of the K-shaped economy, where those that are on the upper end of the income and wealth distribution, the upper end of the K, their things are growing. As you can see here, that brown line, that top line there is luxury and upscale hotel. That has been remarkably consistent through the pandemic. It slowed down a bit, but then it has leveled off and continues to remain relatively strong in terms of projects that are in planning. However, if you look at some of the other categories, they, relatively speaking, haven't seemed to respond as much. So it is the case that in the hotel market, it is really the K-shaped economy, those luxury hotels that are really supporting the market. This is not to different than what's going on for consumers more generally, where has been the case for a better part of a year, where the luxury consumer has been really increasing their consumption, whereas consumption among the lower income levels has not been growing quite as much. We're also seeing something similar to this in office renovations. One, we are seeing a lot more office renovations. This should come as no surprise given what has happened since the pandemic. Hybrid or work from home has meant that a lot of there are a lot fewer offices necessary, or office spaces necessary. However, the office space that is necessary needs to be of much higher quality. So what we have been seeing has been a lot more of alterations, upgrading Bs and Cs to As, or trophy spaces. It's a lot more about location and taking a good location and making it even better. We're also seeing alterations happening in markets in the suburbs. Since the pandemic, many people have moved outside of urban areas, and there are more regional office spaces that need to be upgraded to encourage those workers to actually return to the office. So that's all sort of part and parcel of the same sort of dynamics that we're seeing, and we expect to see throughout 2026 and 27. As I'm sure many of you in the audience probably know, within the office, in this particular case, we're actually splitting out traditional and data centers, because within the office category is housed our data centers number. Data centers, of course, are still going gangbusters. We have a map here from Billy Roberts, an amazing cartographer, does some really great work at the National Laboratory of the Rockies. This is an updated version of a slide that I've shown in the past. What's really cool about this particular one is it's showing the natural gas pipelines, transmission lines. So the gas pipelines are in blue, the transmission lines are in sort of those yellow and red. And what I really like about this particular chart compared to some of the previous ones is, in addition to showing the current data centers that exist, that are already operating, those are all in yellow. We then see those that are under construction in orange. Those circles that are in orange are those data centers under construction. And then the gray or whitish gray ones are those that are planned. So that's these are all, and the size of them are done in terms of megawatts, right? Now, what's really fascinating about this comes from a bunch of different things. Is it can be no surprise why Texas seems to be the hub of all these data centers. If you see how much of those transmission lines and gas lines are sort of streaming across that part of the country, it makes total sense why there are a ton of data centers there, right? Power is one of the #1 things that a data center operator cares about. The other one, of course, is speed. Regulations in Texas are some of the easiest to get through in the country. That is that most, if you take Virginia and Texas, it takes about 3 months or so to go through the permitting process. If you go to a state like Colorado, where you might think would be a great place to house a data center because you don't have to pay for as much cooling given air temperatures, it just takes 12 months to go through the permitting process there. And so it just takes a lot longer to get through. The other thing to note is how much white is showing up basically on the I-95 corridor. This is also an area where there are tons of people living. This is showing you the maturation of the data center and AI infrastructure. All of these companies need to actually turn a profit to sort of reward all of the investment that's been placed in capital with them. And it's pretty clear the only way that they're going to do that is have the lowest latency to answers from people's queries, which means you need inference centers that are close, and storage, more importantly, storage centers, right? So people are sending in videos and pictures and expecting pictures and videos and stuff coming from their cloud as well, that takes up a lot of space. So it's no surprise that there are a ton of these smaller, you can see they're all much smaller circles along these areas where there are a high concentration of people. So that's what's going on with data centers. Of course, a lot of activity there. Finally, we wanted to, or not finally, I've got a couple more slides. Want to sort of take a look at what's happening on the institutional side. What you can see here is our assumptions about what's happening to state and local government expenditures on structures. Compared to our forecast in January, we are expecting a further slowdown over the next couple of years. This is one of the reasons why our institutional forecast is going to be pulled back. We're specifically seeing this in places like education. So if you think about that, really what's happening is it doesn't necessarily mean that anybody has targeted education, but if your overall budget is shrinking, you have to make choices. And it seems that most of the time those choices have been to slow down education spending. We've been seeing a very big pull back in K through 12 expenditures. This is also impacting, to a lesser degree, streets and bridges, so infrastructure. It's having the same sort of impact. A lot of those projects have been very slow to come about, even with IIJA funding. A lot of that has to do with risks around additional costs that are either unexpected or unknown, given the sort of volatility that we're seeing, particularly with now diesel prices going up so much. So this has led us to really scale back some of our education forecast, particularly in K through 12. We're also pulling back universities. This has more to do with the broader environment in university funding, thinking more about decreases in NSF and NIH funding. That is going to have a huge impact on construction at these large institutions. So far, that has been coming on a little bit slow, but I expect more and more cancellations and abandonments over the next year or so in that particular category. We're going to wait a little bit to really pull that back, depending on how we actually see that flow through on the data. So you'll see us sort of incrementally adjust as we get more and more information on all of these sectors. The last part that I'd like to talk about in terms of specific sectors is healthcare. We are seeing a very big drive in large hospitals in urban areas. Those hospitals, if you look here, we're looking at the square foot numbers on the top chart and the millions of dollars of project value on the bottom chart. What you can see, if you sort of do the math here, is that clearly cost per square foot is jumping dramatically over the last 3 or 4 years in hospitals, right? The amount of square footage has gone up a little bit, but relatively speaking, the value has gone up a lot more. These are very, very large projects that tend to be in dense urban cores. We are hearing from some of our clients in more rural areas, though, that hospitals are actually in decline, right? They're either merging or they're closing down entirely in favor of going towards some of these urban cores. And that trend we see sort of going forward. So even though in some areas it's going to feel as if there's not a lot of hospital activity, overall there's going to seem like there's more, just because the values that are coming through of the projects that are coming through are quite large. Clinics are still remaining quite strong. A lot of this is driven by a need to reinvest in senior living. This has been a strength for the last year or two. It's been a strength for the last couple of decades, but we did sort of slow down for a while through the pandemic era. That is somewhat reinvigorating over the last year or so. We see that continuing, but with a little bit more trepidation than the first round. Finally, I'd like to just hit on a few key points before we turn over to Q&A. We have this backlog of projects, and they're moving very, very slowly. So that backlog is going to continue to grow over this year. One of the reasons for that is because volatility will continue, right? I was hopeful at the beginning of the year that we had turned a corner in terms of uncertainty, that the tariff situation was more or less handled. Yes, we might get a change here or there, but more or less people are okay with what the current tariff levels are. The effective tariff rate was more or less going to stay the same, and therefore we could handle that. However, the conflict in Iran, how this has been handled in terms of trying to step away from the conflict has sort of been an off and on again. If you just look at oil prices, you can see the volatility there. That is going to continue, and I don't see that changing anytime soon. It could be that we, as a collective, meaning business owners and so forth, are just more used to the volatility and are able to power on through that. But my contention is that that's probably unlikely, in the sense that the volatility seems to come from different places at different times. If it's not tariffs, it's now oil. Well, I don't know what the next thing will be, but I'm sure there will be something else that drags our attention and makes it hard for businesses to make decisions. Consumers and businesses will, of course, adapt. We did a great job through the last year handling the tariffs. That's why there was so much project planning. However, like I said, just because we put a lot of projects into planning doesn't necessarily mean they're going to come out quickly. With uncertainty, people take time to make their decisions. They might be adapting, but they're still going to take time to make their decisions. And that time costs money, and that cost is going to make things go slow. We believe, of course, that data-driven decision-making will improve those outcomes. This is one of the reasons why we give these Outlook talks. It's one of the reasons why we do everything that we do here at Dodge. So please feel free to reach out to us if you're interested in hearing more. On the right-hand side of this chart, of course, you see our forecast broken down into residential, non-residential, and non-building. As you can see there, on the residential side, we're seeing things be very, very flat. This is in terms of real construction starts, where we have stripped out the inflation effects. We are a little bit more positive in the non-residential space, but a lot of that is coming from strength in data centers. On the non-building side, there's quite a bit of slowdown. Again, a lot of that has to do with very large energy generation that is probably going to roll off in terms of sort of a tailwind to the non-building sector, and a flattening of streets and bridges. Basically, the funding from IIJA is running out. It's likely to be re-upped, but not to a degree where we see further expansion of infrastructure. So that, broadly speaking, covers all of the construction forecast that I wanted to present today. I'm going to invite Sarah to join me now for a bit of a Q&A. I'll go to this last slide here. One thing that I wanted to also sort of clue you in on, something that we're doing differently, is we wanted to make it a little bit easier for our clients to get in touch with us. We've created a sort of a new email, econhelpdesk@construction.com. Please send any questions you have about economics or a forecast there. This will make it easier. If you send it to me, I might not be able to look at it. I want to send it around to other people. So send it there, and we have a team that will be looking at that. We'd love to hear from you, and we'd be happy to get back to you. All right, Sarah, let's take a look at those questions.
All right, yeah, we have some good questions coming in. I think first, do you want to just give us some highlights on what we're expecting to see for our outlook around manufacturing? Specifically, we had a couple questions around, what types of manufacturing are doing well right now, which types are not, and if we're seeing any impacts from potential, reshoring.
Yeah, so this story has remained largely consistent. We do see some semiconductor facilities coming on. That was where all the strength was a couple of years ago. That, of course, is slowing down a little bit as the CHIPS Act funding is no longer really in effect. However, we now have a concentration within this particular sector that allows along that vertical for a lot more opportunity. In an era where there is a lot of volatility, being able to be close to the production cycle is actually a really big benefit. So we see a lot of new facilities along the verticals that either feed in or feed from semiconductors and batteries being an area of strength. We do have manufacturing coming in a little bit this year. It was a strong year last year. Again, even though the numbers are declining, the growth rate is negative. If you compare to pre-pandemic levels, we're still a good $20 billion, $20 billion a year higher run rate than we were pre-pandemic in manufacturing. So we are probably still saying that things are going to slow down in terms of the growth rate is negative. However, the number, the level is still pretty robust compared to pre-pandemic levels.
Okay, great. And sort of along that similar line of thinking, what are we expecting to see for the warehouse sector in 2026?
Yeah, warehouses, also an interesting sector. We have seen a bit of a rebound from Amazon. That's usually our bellwether to get a sense of what's going on in the warehousing sector. Last year was a pretty good year for starts in Amazon, more consistent with pre-pandemic levels after 2 years of pretty anemic warehouse production from Amazon. We're seeing that sort of across the board, a little bit more strength in warehousing. It is a lot more, fewer of the very large 3 million square foot type facilities, a lot of smaller facilities that are sort of focused on last mile deliveries.
Okay, thanks. So a couple questions around maybe some federal funding. So the first one is just asking kind of what our assumptions are with the expiration of the Infrastructure Act. Are we assuming something else? And are we seeing any impacts from the requirements of products being manufactured within the U.S.? So that's sort of.
Sure. With IIJA, we are assuming that there will be a sort of re-upping, basically a continuation of spending on similar levels. This is a sort of bipartisan issue. Everybody agrees we need more infrastructure. It should be an easy win. And so we expect that that will come through. There is some uncertainty around that. But again, that seems like the best baseline to have. If there's any risk there, it's actually to the downside that either something doesn't get passed immediately and there's some limbo period, or that the package that does come through comes in on the light side. It seems unlikely that will go very excessive in terms of spending on infrastructure, largely because of budgetary concerns.
Okay, great.
And you had another question in there too, right?
Just with the requirements around products being manufactured in the U.S. and using that. And
yeah, I haven't. What we would be looking at is more anecdotal evidence in client conversations, and I have not heard that be a major concern for many clients yet, or something that they've been talking about as being something that has been impacting the industry too much.
We're also getting some questions around just energy generation. I think you had mentioned that, or some questions say large energy generation will roll off in 2026. Obviously, we have a big deficit, right? We need a lot of energy infrastructure right now. So what is sort of your narrative around that?
Yeah, sure. So we have about, something like in 2025 and 2026, something on the order of uh, uh, $30 billion of in both years of energy production happening, or energy facilities being built. It is going to come down a bit in 2027, 2028. A lot of that has to do with these are projects that take a long time to get into train. You really there's highly regulated industry, so you want to sort of hedge your bets there as well, considering what the historical norms are. That being said, 2025 and 2026 are record years compared to all the 10 previous years before that, right? So yeah, there is a lot of energy production happening. We anticipate that this is going to roll out pretty strong. Perhaps not as strong as the last 10 years of growth in terms of capacity, but it will still be, and that has actually been really strong, actually, the amount of capacity that we've added over the last 10 years. But it's probably going to be pretty close to that type of capacity that's being added, which, given that we've got population growth that's actually slowing, that actually nets to a lot of power being added over the next few years.
Yeah, makes sense. On the K through 12 side, we were talking a bit about how that looks relatively weak right now. How do you see sort of school bonds supplementing K through 12 activity?
So it seems, so I think there we're having a problem. Municipal lending, again, that's going to be highly idiosyncratic, which municipalities actually have the credit to be able to borrow and sustain those kinds of things. In general, the areas that really need them might actually be the ones that have the least amount of room to borrow. One of the big things that we're also seeing on the K through 12 side is, though, that given changes to immigration enforcement, we're also seeing a slowdown in household formation. Less households mean less kids, which means you need less schools. So there's a little bit of a trade-off going on here as well, that, well, we don't need to spend as much on schools because we may not have as much demand as we thought we might have. So the sort of pressure to do that is a little bit less. And so should those bonds come to fruition, they would probably lean more towards alterations instead of additions, because we're not expecting more and more kids. We just need to renovate the spaces that we've already built to just make them a little bit, nicer, because they're starting to get dilapidated in certain areas.
Right, or just be fully replaced.
Yeah. Correct.
Okay, also a handful of questions here just about our project delays slide. So, what do you see as the major drivers behind that what's slowing things down in general? Some specific questions too around just multifamily, if there's anything in particular that we think is different for multifam kind of slowing projects down in that case.
Sure. So in multifamily, I think the story really comes down that one is more about the regulatory environment than anything else. And it's not necessarily the regulatory environment itself, but if you go back to that slide, think back to that slide on where the housing shortage is, those are all in those pink states. Those are all some of the most expensive. However, those also happen to be the areas where it is the most difficult to rezone and have some of the most stringent environmental protections. And so that just means it's going to take longer. And those are the places where we need multifamily homes to solve the affordability problems. And so you're just seeing more projects that are in those areas. Those areas take longer, and therefore you see an increase in the timelines. In the other areas, a lot of it we suspect is coming from just the general uncertainty. If we talk to clients, they sort of echo this, that they feel like things are just getting hung up. They're taking, when it used to take 2 weeks, it's now taking 3 weeks to make a decision, or 4 weeks. If we sort of think back, those sort of rose-colored pinkish bars there for 2025, when we were tracking this, you'll see that 2026 is year to date. We started around the same time in about March, and we were tracking those year-to-date numbers, every month those were getting longer and longer and longer. And I attributed that, as we were going through, to the levels of uncertainty that we were seeing around tariffs. Now those levels of uncertainty are around oil prices and sort of geopolitical risks. But it's the same story, roughly speaking. It's a lot about uncertainty.
And of course, labor shortages too, right? I think there's a question here: could that also be contributing to these delays?
Yeah, labor shortages tends to be a lot more idiosyncratic. If you think about it, a lot of the labor shortage, so there are multiple things impacting labor shortages. The first has to do with some of the mega projects. So think about Texas. You've got lots and lots of those data centers going in. Some of them are huge. They all require electricians. They all pay very, very well. So all the electricians are going there. And so it's really hard to find an electrician in Texas to do, a hospital or something else. And so, okay, that's going to hold things up, and sort of sorting out those subcontractors as part of your process is going to take a while in those locations. That's one part of the labor shortages. Then there's also the immigration enforcement, which, again, we don't have very good, hard data on this, but certainly anecdotally, and there are certainly some indications that that in areas where there is a high volume of foreign-born workers, which is mostly the southern states, California, Texas, Florida, there's a few of them up in New England, New York, New Jersey, where the number of foreign-born workers in the construction industry are 50% or more. In those states, immigration enforcement is certainly impacting labor shortages, and they're particularly impacting some of the sectors more than others. So if you think about drywall, for example, that is overrepresented. I think 60% plus of the workers there are foreign-born. So depending on the type of subcontractor that you're talking to, there are also labor shortages issues there. And that is very, very idiosyncratic. If you look in the middle of the country, it's single-digit percentages of foreign-born workers, and so therefore there isn't as much of an issue there. It's really in those areas where you see a lot of foreign-born workers where you're going to see those labor shortage issues.
Yeah, makes sense. Okay. I think we'll have time here for just one more question. This is a fun, sort of tricky question that I feel like you like to answer. But
awesome.
Do we expect oil prices to kind of ever reach $200 a barrel? I know there's some mention in the news that, in a worst case scenario, we could get there. And if so, what would you expect to take place from a macroeconomic perspective?
So I think it's much more likely that we get that as a spot price. So when you're literally exchanging oil directly, as opposed to the numbers that I was showing are actually sort of futures, 1 month ahead delivery. Those numbers, they're wildly different from each other at the moment. I think there's something like a $15 difference between those quotes. We certainly could see that on the spot side, given the restriction in oil production. Soon, within 3 months. I think that if things continue the way that they're going, I think that is not a crazy assumption. It's not my baseline. My baseline is that we more or less get some sort of resolution. It's going to be uncomfortable. We'll probably have oil prices around $80. If we go to 200, we're going to be in recession, global recession. It's very likely that will also produce, given the dynamics, a stagflationary environment. So it's going to be very, very uncomfortable. The Fed will likely start hiking. So will other monetary policy makers. So yeah, that will be a very calamitous event. That, of course, will have important ramifications in the construction industry. The higher oil prices, we already see it in diesel prices, right? Just even going to $100 per barrel has rapidly increased diesel prices in the U.S. That matters a lot for construction, and so that would be would really hit us on the nose. So on that happy note, well, I'd like to thank all of the people who have joined us here today. It's a pleasure, as always, to talk to you. If you do have questions, please contact econhelpdesk@construction.com. You can certainly follow me on LinkedIn if you don't already. And when you do close this screen, you will be invited to participate in a survey, which we would very much appreciate. Thank you very much. Enjoy the rest of your day.